Over the last 24 hours, the SP 500 has dropped 1.37%, and this has sent the bears absolutely wild. But if you take a closer look at the chart, you can start to see something very interesting forming. That, along with the rest of the historic macro analysis that we cover here on the channel, is giving us a huge opportunity against the masses. Let's take a look at that in today's video, along with some of the other major macro data that we've covered here, and looking at this as an update because it gives us some pretty decent signals coming into the end of the year, setting up for the perfect storm in Q4. So, you know what to do. Without further ado, like and subscribe. You're really hitting that like button with full force, getting us up to nearly 10% on each of these videos. So it's doing a lot of value here on the channel. It's your home of macro cycle analysis, studying the past to forecast the future, crypto, Bitcoin, stocks, and real estate. We cover all of it because it is all important to understand where we are in the macro cycle. Basically, very, very important. Okay, let's dive into the first piece. And like I showed here, probably on the thumbnail, we're looking at this, the VIX falling to below 14 in August. And what does this mean? I think it's important to come back to this data because it gives us the roadmap moving forward. Essentially what this has said, and this was all the way back September 1st, so over a month now. It's not old data, it's a roadmap for what's coming next, and we're just looking at probabilities here. So when the volatility index falls below 14 in August, the S&P tends to rally in September, consolidate, correct in October, and rally again in November. So the traditional seasonality trends for stocks might play out a little differently than expected. It's not too different, but it's not exactly the same. Of course, it's history. It doesn't exactly repeat, but it rhymes. Now, we saw September rally into mid and then fall away at that point. October, one day up, we all got excited, and now we're seeing one day down. Is October going to continue like this? Obviously, that's the question. But the end of the year, in all regards, we're basically looking at the movement up for the latter half of Q4. This is part of the roadmap that we've covered on the channel. Just looking at the data, S&P 500 went up 10% or more at the end of June. So for the first 6 months of the year, the market is up 10% or more. This is typically what happens, and this is given to us here from the 15th of August, so coming into 2 months now from this data. And you see July, you're getting a little bit of a peak there, late July, early August, the market trending down. Through the orange period, up to 10% year to date in June, it shows sideways, but all we're looking at here is a trading range. So it doesn't have to be exactly like this, but we may see a trading range, typically based on historic data, that takes us out to roughly the end of October before we start that climb ahead. And pretty much that's what we're beginning to see here on the S&P. Late July, had a pullback into August, a rally here into the early part of September, then the mid part of September, and then we've had this recent drop into this current low, which is on the 2nd or coming into the 3rd of October now. And so as we start to climb out of October, ideally, this is what the data is suggesting, is that we start to see the market at least put in a low and start to climb higher towards the second half of Q4, last 6 weeks or so of it. So we still have plenty of time. We're hearing big noises from the bears at this low, and the market has really only taken out the bottom of the 27th by 0.5%. And on a closing basis here by 0.2%. This can obviously change, but basically that's where we currently sit, and the noise has been huge, which we'll get to on the fear and greed index as well. So keep this in mind. It is going to help out a lot, especially as those bears keep thinking the market is about to fall out of bed. The dollar, it hasn't fallen out of bed yet. It is on the climb, and it looks like it's running out of steam. Now, this is a pretty good analysis that my brother put together on his channel, so I'll leave a link to this in the video description that goes into a lot more detail here. But what we're looking at for the time being is the rally dying out here with lowering volume. You'd want to see some good volume coming into the market as it breaks out of key levels. We are, of course, at the 50% level. So that's basically where you would expect the market to at least find some resistance, and that's exactly what's happening right now at around 107. And that, of course, is potentially some of the reason why the stock market and commodities Bitcoin are finding a little bit of a struggle street trying to work their way higher. But if we start to see the turn here on the dollar, then maybe we'll see a little bit of relief for the stock markets, which also works back into the timing here across the roadmap as well. So the DX looking like it's not going to be a sustained rally longer term. Macro here, we're not talking about the daily or the weekly. Let's get the facts straight. This is longer term. As we've pointed out many times before, these tops can take years to form, like the previous one here from late 2000 into early 2002, so roughly 18 months. Maybe that's what's going on here. We're now 12 months in from the top, and maybe we have several months left, 12 months left until we really start to see this thing fall away. Let's keep going. Trend is up, but we're starting to see some of those signs, especially when it comes to the lowering volume compared to what the market has done in the past on those bigger moves to the upside. As I said, I'll leave a link to Michael's video in the video description as well. Speaking of further education, you guys can get a link to this in the top of the video description. This one is absolutely free, weekly crypto and economic report, trading guides and discounts. Sign up to that. There's plenty coming out on that. And if you do want to become a TIA premium member, as we have done with our members this morning, went live as we do once a week as well, plus plenty of exclusive posts, as you can see throughout the Discord here, to help the part-timers and the full-timers in the game of trading and investing across crypto, stock markets, and real estate. Again, links are in the top of the video description. You get the idea. Let's move on. This is where the market has gone absolutely bananas this morning. The bears are super loud. They think the sky is falling in. The market's ready to hit new cycle lows, but as you would know, when you take a look at a chart, they are screaming bloody hell at this point, and they screamed it back here, and they screamed it back here, and they screamed it here, and they screamed it at the lows. But this is a bull market of higher highs and higher lows. Technically speaking, that's one point. Technically speaking as well, it's 20% above the bear market bottom. And we're coming into the second half of the real estate cycle. So this is what beginnings of bull markets look like. The bears are typically wrong on these accounts. They're calling for all sorts of bigger targets to the downside, but just be aware of the chart. Just come back, look at the chart when you hear them screaming that the sky is falling in. Go and look at a chart, because you can see that the prices are higher on each of these occasions. So that's where we sit. The fear and greed is at some extreme levels. And basically, what we have seen in the past, looking at the timeline here, is these levels pretty much are rounding bottoms. It doesn't necessarily mean that today is a low, like I talked about yesterday, that it doesn't mean that this has to be the exact low, but it seems like we could be in a low forming territory for the SP 500 and potentially for the NASDAQ as well. If you take a quick look at this, it hasn't been able to breach the August low yet, which is showing that it's stronger than the S&P 500. Doesn't mean that it can't break down if the S&P was to go a little bit lower, but it's showing stronger signs of holding up for when the recovery does come to the upside, that you'll probably see bigger gains on the NASDAQ than we will on the S&P. That's what that signal is saying, because it's holding up a little stronger here. In terms of the pullbacks for the S&P 500, we're now at 8.5%. Talking about the pullbacks on the S&P 500 and the single digits that we were looking for in 2023, because the market is in a bull market, you would typically expect probably single digits on the pullback. The 10% or more happens about once per year, and we got pretty close to that on the S&P at 9.2%. We could measure the one back here on, well, it's December into December, so that's at 8.2. So we're roughly sitting about the same percentages here. And if this market was to go to 10%, give us that slight, or get into the double digits, that could be all the way down at 41, 46, which is roughly around the 50% level here. So we could get back down to that 40 and 50. That would take us down to 12%. And the 10% is basically around that 41.50, so about 100 points off the 50% level within the previous consolidation zone before the pullout. So it's already in that zone here, 8.5%. Things are looking pretty rosy. Taking a look at the pullbacks, everything is in line with the data that's been collected for over the last 70 years for a reasonable pullback on the stock markets. And as Bob has pointed out here, S&P currently down 8.5 from the weekly high, exactly what we just had a look at here on the chart. bang on around that sort of 8.5. That then shows average weekly decline with a bull trend occurs twice a year is about 6.8. So call it 7%. It declines twice a year in a bull market. Correction of 10% in a bull trend only occurs every 5th cycle low on average, approaching buy territory. So there's a lot of indicators coming out that we're probably approaching buy territory. And one of my favorite ones is when I just have a look at what's going on Twitter, and you see the people who have been macro bears hoping and praying that their call is right, that the market is going to go back and break some of these cycle lows. They got very, very loud today. And I think they might find that they may have in fact called a low, because they are screaming bloody hell when the fear and greed index is at some of its lowest readings that we've seen in a long time. Moving on to how is this even possible? How can the market keep going up when everyone's in so much pain? Now, I'm just going to bring these up quickly because it really shows that there is more money on the sidelines. We talk about a lot of data here on the channel. I'm not going to talk about every single point every single day. So keep up to date, hitting that like and subscribe button. Of course, click it down below. I'll give you that second to do it. Now, household debt outstanding as percentage of GDP. Household debt is so low. Household debt outstanding as a share of US GDP is about back to turn of century 20-year low. There are many reasons to be upset and concerned. This is not one of them. So thanks to Seth and Mike here, household debt isn't as bad as the media is playing out. Also, what's not as bad is credit card debt. They talk about the dollar value, but you need to look in terms of a percentage. Credit card debt is at 6% of dollars people have in their bank account, around the lowest percentage in 20 years. So you've still got pretty low rates, but the media will always look at the worst number. That's how it happens. If they want a negative headline, they'll look at the worst number. In this case, the number that looks bad is 1 trillion, but as a percentage, it's only 6%. And yes, it is climbing. That's to be anticipated and expected for the second half of the real estate cycle, because credit is becoming easier and they're starting to throw more credit. The banks, etc., are throwing more credit at everyday people. So that credit will increase. That is what will lead things to a collapse. It's not time yet, but it will be. So I'm not a perma-bull. I'm only bullish when the market is saying up, and I'll be bearish when the market is ready to flip. It's not ready to flip yet. There will be a time that will have to get very bearish, and the catastrophic collapse will come. Guaranteed. It's baked in. Has to have a major collapse. Now is not the time. NASDAQ also not ready for a major decline. We just see that 9%. So just following up here, 14,400 is the 50% level. So still looking at pretty good areas for support to come into these markets. As for Bitcoin and crypto, which I guess the majority of you are here for, let me know in the comment section down below. Top pinned comment, I'll ask you, are you here for Bitcoin and crypto, or the stock markets, or both? Let me know. Reply to that top comment there. It also helps out the YouTube algorithm, and it's fun to see what other people who are watching are interested in. As for the interest in Bitcoin and crypto, I've got a good segue there. There is not much interest overall in the overall market. Bitcoin and crypto are declining here. BTC was at 16 last couple of weeks, 2 weeks ago, and last week was dropped to 14. Crypto's at 6, 6, 6, 7, 6, 7, 7, 7. So you can see here it's basically just on a downward slope. If I take out Bitcoin from the Google search trends, I've taken out Bitcoin, and you can see that crypto is on a pretty steady decline as well. Just taking out that extra data there because that is a lower search term. It went from 24 to 21, down and down and down into the teens, and now floating around 16. So it's still higher than it was in 2020, but it is definitely still on the decline here. And we're not going to see any sort of big pumps, those big altcoin seasons like we saw in early 2021, until we really start to see the trend change. Look at that, higher highs, higher lows. TA works on just about everything that you can chart. And if we throw it back to Bitcoin, it's in the same sort of trend. On the decline here, it's sitting at levels that it was in around 2020. So it's back to this zone here, but you definitely want to start to see the higher highs and the higher lows form again. Now, does that mean the Bitcoin is going to collapse from this point? Of course not, but it doesn't rule it out either. the main price point that we've been focused on since the low came in on the 11th of September is 28,400. So the market, Bitcoin in this case being the market, needs to get back above 28,400 and consolidate for the bulls to have hope in testing 32 again. Of course, it makes sense. It needs to get above certain levels. But if it comes back to test this high again and rejects, then we face the music and probably come back to test 27.3, and then the next level's back here around the 26 level as well. So the reason for that is the 50% level, of course, super strong there. It's been rejected once, close here, and it was somewhat support back in August. So it's a key level, 50%. You're seeing them, I'm seeing them. You're seeing how easily it works out when you're able to apply the tool to the correct areas. And if you want access to the tool, TIA Gann Swing Indicator, that is in the video description right here, TIA Gann Swing Indicator, and you get extra indicators included with that one as well. So go over, check that one out. As for BTC, we've had a little bounce here on the shorter term 50%. Got to see how the next 24 hours plays out. For now, the trend is uncertain, but the market is up at this point, testing higher prices. And I say uncertain because you have higher highs, but lower lows here. And if this is able to break today's or the next following days are able to break above yesterday's price, that will turn the trend up. And we attempt that next repeat, or we attempt 28,400 again, whether we repeat and reject or break out and hold above. Let's see what happens from that point. So Bitcoin really hasn't given us any other clues what's going to happen over the next 24 hours because, well, yesterday was a settling basis here above 50%, so it's in the stronger half. So we have to give the bias to the upside again for another test to some higher prices. Like and subscribe if you want to follow me over on Twitter or on Instagram. You can see more of the travels over here. If I don't post a video, it's probably because I'm out having a meal somewhere in Greece or next week in Thailand. But I'll see you back here on the channel to talk more about the markets, the macro cycle analysis here on your home of the macro cycle analysis. Till next time, take care and peace out, guys.